afternoon, everybody. Today is Thursday, June 2nd, and I'd like to welcome you to this week's installment of C-Suite Snacks. I'm Steve Ronan, the leader of Citrin Cooperman's consulting and outsourcing practices and the host of this webinar series. As we heard in our M&A session on the 16th of May, the environment's been very strong for selling a business recently, but that isn't always the right transition solution. Many businesses, particularly closely held businesses, look at employee ownership as a good option for transition. In many ways, these instruments are a good balance between benefiting the owners, employees, and setting up the company for a sustainable future. To explore more details of ESOPs and to see if it might be a good option worth exploring for your business, today we're joined by Howard Klein and Heather Oboda to explain the finer points of ESOPs and some of the key considerations if you think employee ownership might be a potential direction for your company. As always, we ask you to submit questions throughout the webinar, so please locate the Q&A button on your Zoom screen and feel free to enter your questions there as we go. We'll be saving time at the end of today's presentation to address the questions we receive. As we do every week, we'll also be doing our snack basket giveaway, where a lucky attendee from today's session will win a craft basket of snacks. The winner will be announced at the end of today's session. Finally, if you're here because you found it on our website or on social media, I encourage you to sign up for our mailing list to make sure you receive an invite for our new snack size topics each week. Please also visit our C-Suite Snacks Content Hub on the Citrin Cooperman website to view the recordings and look through the decks of prior presentations. And now, without further ado, I'll turn it over to Howard and Heather for today's presentation. Howard, over to you.
Thank you very much, Steve, and good afternoon, everybody. Steve, thanks for having us today. Give me a good excuse to put on a suit, and thank God it's still fit. So during the last few webinars that Steve and his guests have had, basically starting about 2 weeks ago and some before that, as Steve just mentioned, there were some various issues discussed regarding how business owners can exit their businesses. With the potential tax changes that you might have heard maybe coming out of Washington and many states, the current environment has created one more additional layer of uncertainty to an already very, very, very complicated process. So today we're going to talk, and I want to go through very, very quickly some of the options that, just kind of a recap of what business owners might have available to them. And then we're going to focus specifically on today's topic, which are ESOPs. So here basically are the options as we see it that a business owner has. They're self-explanatory. Time doesn't allow us to go through every single line of every single one of these presentations, and we're always available for questions either today or in the future. So today we're going to be focusing on the fourth item, which is employee stock ownership plans. What's interesting about these options is that, ironically, and actually somewhat disappointing, most business owners think that their decisions as to how they're going to exit their businesses will result in a positive outcome. Many of these are potentially positive outcomes. However, statistically, the overwhelming choice ends up being the final option down there, which is to liquidate. One could argue that this is because of a lack of planning. So today we're going to focus on item number 4, selling your business to your employees through an ESOP, employee stock ownership plan. We only have about 25 or 30 minutes or so we're not going to have the time to go too deeply into any one specific area of ESOPs. So if you do have certain questions and they're a little bit more elaborative, we may have to defer that for another time here as time permits. So we're going to discuss 3 basic components today. What an ESOP is, what are some common misconceptions about ESOPs, so as to what exactly is an employee stock option plan, and then finally, on a current basis, why this current climate could make an ESOP potentially more attractive for a business owner to consider. Okay, so what is an ESOP? First, let me just spend a few moments about the ESOP market. So this may or may not be interesting to some of you, but we found some statistics. There are approximately 7,000 ESOPs throughout the country. They're active participants, meaning employees that participate in employee stock ownership plans, are about 10.7 million. And we know about these statistics because there's reporting requirements on an annual basis, which we won't go into during this presentation. There's assets and values of businesses of about $1.4 trillion. Gives you a sense of what the privately owned and, quote, small business market is like. ESOPs are basically industry agnostic. Some are better than others. The metrics in looking for a potential candidate to discuss an ESOP is a company that has strong EBITDA, a minimum of $2.5 million or more. And there's always exceptions to everything that we're going to discuss today, plus a large employee base. Interestingly, some of the largest ESOPs in the country are actually supermarkets. They have lots of different establishments, a lot of different, especially chains. Publix, I believe, is the largest ESOP in the country. They have strong earnings and a lot of employees. So these metrics go into, at the outset, whether a company could be a good candidate for an ESOP. And quite frankly, it's more likely than not your company is not a good candidate for an ESOP, to be totally candid. Before we get into some of the heart of today's conversation, I did want to mention one point here. During the webinar a couple of weeks ago, Ramsey Goodrich, who may or may not be on the call today, who's an investment banker, really hit home with me because he talked about three pieces of a transaction regarding readiness. And I really, I'm going to be using this in my repertoire. Ramsey, if you're on, I'll give you credit, but I'm definitely stealing it. Three pieces of any business transaction require readiness by the owner, the company, and the market. And I thought this was a great point. And Ramsey went on to say that the market's always ready. You can always get a company to be ready, but the hardest piece is to get the owner to be ready. Is the owner or owners, shareholders, are they ready for a transaction? Okay, often they're not. But I think it's kind of a come to grips moment, and I think it's extremely important. So an ESOP addresses this issue head on because, unlike some other exit strategies, which are on the option list, in an ESOP, the owner usually does not give up control, actually, of the company. So what is an employee stock ownership plan? I'm going to actually read the definition that's on the screen. So an ESOP, we love acronyms in the accounting and tax world. An ESOP is a qualified, defined contribution employee benefit plan that invests primarily in the stock of the employer. Practically, however, it's a tax advantage way to sell all or a portion of your business. Okay, the business owner sells all or part of their stock to the company. The company creates an employee stock ownership plan. Think of any other kind of a profit sharing plan. One of the primary differences is that the assets, at least at the very beginning of the defined contribution plan, are ownership in the actual company. All of the employees become participants on a vesting schedule. Lots of details here I won't go into, but basically your employees, with certain exceptions, are the participants in the ESOP plan. The business owner sells the stock. It's a price that's negotiated between the shareholders. When you create an ESOP, no different than any other defined contribution plan or any kind of deferred compensation plan, that plan has a trustee or trustees. Those are the people in charge. Okay, I'll get to some of the common misconceptions about an ESOP in a moment. You cannot pay more than fair market value. There's an independent valuation firm that comes in and it advises the trustee, not the selling owners, about what the right price is to pay for the stock. Okay, and then there's various methodologies which I won't go into as to how the price is actually determined. We can go to the next slide, please. So with an ESOP, one of the things in preparing for today that seemed to resonate was that there are what I'll call financial benefits, and then there are non-financial benefits. Okay, when you sell all or a portion of your stock back to your company, and then that stock eventually gets sold right away to an employee stock option plan, the first thing is that you know who the eligible buyer is. It's in effect your own company. Okay, proceeds that you receive from the sale could be reinvested in other investments. It also, as I mentioned, allows for a gradual sale of the company, unlike a situation where you may be required to sell 100% of your business right from the outset. And with today's environment, if I can interject here, with today's environment of potential changes in the tax laws, which Heather will go into, people might be getting advice from professionals like ourselves, and many people who are on this call, that this is a good time to sell, but maybe as to Ramsey's point, maybe the owner isn't ready to sell. So you're kind of having your cake and eating it too a little bit here, of potentially doing some sort of a financial transaction, monetizing some of your ownership, but you're not divesting yourself completely of your holding. So that creates kind of an intrinsic value. The owners are paid fair market value for the business. I will leave the tax incentives because this is a very, very big part of an ESOP. It is a tax motivated transaction. And Heather will go into some of that in detail later. I want to focus on number 4, which again, we'll talk about a little bit more with the misconceptions. But when you sell to a strategic buyer, a private equity company, a synergistic buyer, often management, the current shareholders, are often dictated to going forward. You know, sometimes a deal looks like you might have input, but at the end of the day, when you read the fine print or through operations, when somebody's buying your company all or part, they very often want control of it, even operationally. Here, there's no doubt that the current ownership and management of the company can stay in place. So you can maintain your legacy, you maintain ownership, and you're in control of the future of the company. And you can always sell later. Okay, so again, having a little cake and eating it too. If done correctly, item number 5 to me is extremely important because the impact on employees here can be positive. First of all, it gives, if done correctly, a sense of ownership. Your employees, through their participation in the plan, become part of the ownership culture. They feel like they're owners of the business. And one would hope that an individual who feels that they're more than just a payrolled employee, that they have some stake, some skin in the game, might result in a better performance. When your participant employees in your company and they become a participant in the plan, very, very similar to other types of profit sharing plans, you don't immediately vest in terms of the value of your ESOP interests. You have to vest over a period of time. That incentivizes your employees to stay longer. Also, if done correctly, that could increase your ability to attract and retain talent. So these are some, yes, they're financial issues, either now or later, but they're also, if done correctly, can create a sense of goodwill and real value potentially to the owners of the business. Here is something that we want to, so that basically hopefully gives you a sense, again, from 10,000 feet in the air of what an ESOP is. I've left out a lot of the details because time just doesn't allow it. We could literally spend hours on here. And those of you that know me know I can talk for hours, but we'll limit it to the 25 minutes or so that we have today. But here are some interesting and I think very, very important points about what some common out there in the world misconceptions are about an ESOP. One, as I mentioned, in some cases, ESOPs are not right for this type of companies are not right for an ESOP transaction. But to go in with a blanket generalization that my company is not the right type of company is probably doing a short sell here that probably may be worthy of something. Number 2, you don't have to sell all of your company, as I just mentioned. Number 3, we'll talk about in a little greater detail when Heather goes into some of the tax situation regarding an ESOP. But one hears that it's too expensive to set up and maintain. Yes, there are costs involved, both annual and upfront costs. They're significant in many cases, time consuming, takes your attention away from your everyday operations, no doubt. But because this is a tax significant transaction, often the costs get paid for through the tax savings, okay? Number 4, and the last item here, I'll leave for the last piece here, but I want to focus on item, I think it's item 6. My employees will have access to financial information, and I'm going to lose control of my company in number 7, and my employees will have voting rights. All of those things are not true at all. Again, the structure of an ESOP is that a plan is being created, and a defined contribution plan is being created with a trustee. There is evaluation done every year. Your employees, just like any other defined contribution plan, will get a statement that is part of annual filings indicating what their value is of their interest in the company based on evaluation and how they've vested. They don't get balance sheet information. They don't get profit and loss information. They're not in your boardroom. They're not sitting there telling you what to do. So you're hoping you're getting the positive sides of their ownership without potentially the negative side or appearance of negativity as to all of a sudden now I have many, many, many more partners than I want to have. they don't have voting rights. To the extent that the ESOP is a majority owner of a business, yes, that trustee will end up with a lot of power because, again, you could always go back to the agreement, and I'm not a lawyer, but if the original owners of the current shareholders maintain majority ownership and control, you're dealing with minority shareholders, and they are, in effect, having their input generated through the trustee as a minority shareholder. I can't go back is something that we can, again, spend quite a bit of time on. When you sell your stock to the company, very often a lot of these transactions have what are called warrants, which allow you to take back some of the stock that you've sold in future years. Two comments. One, very, very, very complicated. No time really to go into that today. And quite frankly, candidly, I've done a lot of these transactions. I'm very familiar with it. I don't think I fully understand the whole piece of it. I very often have to get them explained to me once again by investment bankers. Comment about your employees not having the resources to buy the company, and the ESOP can't buy your shares because they don't have any assets. Those are fallacies. The ESOP, one of the unique factors of an ESOP is that it is the only type of deferred compensation plan that is actually allowed to have debt. So when the company buys the stock from the shareholders, and then the company then sells that stock to the ESOP has no money to pay for it. So loans are created, potentially back and forth. Again, like we could have given you diagrams, and if people want to go into greater depth, we can do that in the future. But it is absolutely allowable for this ESOP to be unique in that it can actually have debt. So just some additional comments before I turn this over to Heather. When you sell all or a part of your shares, you're effectively taking money off the table, as I said. You're not selling completely, and then you're out, and that may have different results for yourself personally, financially. You're also not continuing. It's kind of like the Olympic rings. You have a little bit of both. So you're maintaining control of your business. You're not giving it up to other partners, a synergistic business owner, et cetera. One final point here before I turn it over to Heather. As Ramsey kind of was referring to, and I keep going back to this, but it's part of what we do at every day at Citrin Cooperman, the decision-making process, whatever type of planning, should always be driven by what the owners and shareholders' goals and objectives are. I view our job as advisors, whether I'm doing an ESOP transaction or a conversation, or just your typical estate planning conversation. Our job as advisors is to find out what the client's objectives and goals are and help shepherd them along the way to help them accomplish their goals. So with that, I want to turn the microphone over to Heather, my partner, who's going to discuss some of the tax issues that arise surrounding an ESOP. Heather?
Thank you, Howard. To begin, there are tax benefits for companies owned partially or fully by an ESOP, as well as potential tax benefits for individuals as well. We're not going to go into the details of the difference between a C Corp or an S Corp ownership at this point, because that would take hours, and this is just a snacks. The key item to know is that all the upfront and annual costs of implementing and maintaining the ESOP are deductible. This includes the upfront feasibility studies to see if the metrics make sense to even start the ESOP. As Howard said, sometimes it just doesn't make sense, and the feasibility study will help that. In addition, the upfront costs that are deductible are the valuation costs, investment banking fees, legal and accounting fees. And then there are the annual costs. There's an annual valuation, accounting expenses, and plan maintenance and reporting expenses. We're not going to go into the leverage versus non-leveraged financing right now. However, note that the loan interest and principal payments and dividend payments are deductible by the company as well. In addition, contributions up to 25% of payroll, subject to some limitations, again, depending on if you're a C or an S, are also deductible. Note that these are for US employees only. So be careful if you have any offices in other countries, for example, Canada. Those employees' payrolls would not qualify for the ESOP contribution and deduction, and would be subject to the 10% excise tax if contributions were made erroneously. Let's see. With the additional costs above that we discussed and the ability to deduct all the new expenses, the taxable income of the entity will be dramatically reduced to almost nothing. So this is also a benefit for setting up the ESOP. Another item to consider is, in addition to this, is that the S Corp, if it is 100% owned by an ESOP, that the ESOP is a tax-exempt pension trust, and therefore it doesn't pay any income tax. So this creates a significant cash flow for the company to repay its stock acquisition and have the company grow and thrive. Next slide. So when someone goes to sell their shares, they could pay the capital gains right away. But why would someone do something like that, especially with rates changing as they are? There's the option for the shareholders to elect a 1042 election and defer the tax. A 1042 is similar to those who know 1031s, where you can defer income tax, and I'll get into more detail with this. The 1041 requirements are that the shares would have to be owned by a C Corp, held for at least 3 years. The ESOP would acquire at least 30% of the shares. In addition, not the seller, the family members, and 25% shareholders cannot participate in the ESOP. Next shift.
Heather, I just want to make one quick comment regarding 1042. I believe, and some people on this call may be able to give me the ultimate answer, that there has been some talk about making these 1042 eligible for S Corp owners, but the election does not have to be made by all shareholders. So if you have multiple shareholders, this is an individual decision to elect Section 1042, as opposed to the company making the decision on behalf of the shareholders. I just wanted to point that out.
Thank you. So like a 1031 exchange, what happens is that the shareholder would then need to reinvest the proceeds into qualified replacement property, QRP, within either 12 months of the sale or 3 months prior to the sale. So again, like a 1031 exchange. Some qualified replacement property is common stock, preferred stock or bonds, convertible bonds, or floating rate notes of an operating company that is incorporated in the United States. At least 50% of the assets of said company need to be active in trade or business, and no more than 25% of gross receipts from passive sources. Most frequently, a company will purchase a floating rate note or ESOP bond, which is a senior secured corporate debt instrument. Simply put, it's a corporate bond. However, this differentiates them from corporate bonds in that it is a combination of long maturities, floating rates, and structure and put positions. There are a number of companies who have issued these notes, such as Bank of America, Citigroup, Goldman Sachs, JP Morgan Chase, Procter & Gamble, to name a few. The key to know about the 1042, as I've said before, is it is similar to the 1031 exchange, in that taxes will not be owed until the taxpayer has disposed of the qualified replacement property. Transactions that do not create a disposition, a taxable disposition, is the gift of the qualified replacement property, the transfer of the qualified replacement property upon the death of the shareholder, or any transfer in relation to a divorce proceeding. So this is a great way to defer capital gains tax, especially with the pending changes that may be or have already happened with capital gains. So instead of the 20% rate under the new Green Book, we may be looking at more of a higher rate. So And these transactions may have occurred it may be a retroactive to April 28th, 2021. This creates potentially doubling of the income taxes. So, Howard?
So I just want to, you can see how fast the half an hour goes before I turn it back over to Steve if there are questions. But so the current environment, we don't have anything certain. I find my answer to most questions lately has been, it depends, which is a horrible answer for any advisor to be giving. But over the last week, we have read what is called the Green Book, which is President Biden and his administration proposals for some changes. You've seen a lot of changes, a lot of proposals, both pre-election and from various senators, et cetera. But at the end of the day, one of the things that seem to be focused on is an increase in income tax rates. And that if an individual taxpayer, and there's always exceptions, but if an individual taxpayer has capital gains and their income is above $1 million, potentially that capital gain, which is currently 20%, could be as high as 39.6%, which is the proposed highest rate. We just don't know when it will be effective. The Biden book talks about sometime in April. We could spend, again, hours talking about what's going on in Washington. We just don't know whether it will be retroactive or not. But it certainly is worthy of a look. So if you have the circumstances where a client is looking to do something with their business, take money off the table, taxes could be, as anything, a part of a transaction, has to work with everything. This may be a good time to take advantage and potentially do a closing. I don't know what the odds are of there being a retroactivity or not here, but we have clients that have, when you sell your notes, when you sell your shares back to the company, if the company gives you notes, you have in effect an installment sale. So you're picking up the gain and being taxed currently on principal monies that you're getting plus interest. You always have the ability as a taxpayer to elect out of an installment sale, which means electing to accelerate the benefit, the tax rate. So it'd be nice to have a little bit more certainty with a lot of these things, but this is the hand that we've been dealt with. So like anything, this is not, you should do this, you shouldn't do this. This is, you should consider discussing it, because it's just one of alternatives to the various options that are available to all of our business owners. It's something that, quite frankly, maybe they need to spend a little bit more time on it, which is difficult. Nobody likes to talk about the end of their business, and they're busy running their businesses. So this, in effect, takes their time away from that. So it's understandable. And that, again, that's where advisors can come in. So with that, I'll turn it back over to Steve. And Steve, I don't know if there's any questions that people have, but we're happy to answer them either today or in the future. We hope this gives you a little bit of a flavor at the top level of what an ESOP is, et cetera. So thank you all for your attention today.
Hi, Howard. Thank you so much. Unfortunately, Steve had to drop for another meeting, but I will be facilitating Q&A. We do have one Q&A, and again, if anyone has questions, you can submit them at the Q&A button at the bottom. One question from Spencer Barback. About how much are upfront costs to create an ESOP?
Good question, Spencer. Spencer, for full disclosure, one of our partners. Very, very good question. Not a simple answer, as you would anticipate. A lot depends upon the complexity of the engagement itself. Who's helping the client quarterback? You're dealing with attorneys for both the company as well as the plan. So there are a lot of costs that the company doesn't control. It could range, to tens of thousands of dollars, and I've seen them be upwards of a couple of $100,000. I don't believe that there's any litmus test in terms of percentage of the value based on the sale of the business, as far as I know. Others on the call may differ, but it gets back to that. Here's a really, it depends answer to a very, very good, appropriate question. And again, that feasibility study, some investment banks will do that gratis and hoping that they'll get the engagement and go forward. Others will charge a minimum fee. Others will charge a true time fee on it. So like a lot of advisors, the answer is it depends upon the situation. And I don't think there's any real, specific answer to the question, unfortunately. I'm happy to talk about it with you, offline.
Yeah, thank you, Howard. Again, if anyone has any questions, we'd be more than happy to follow up with you after the webinar. You can always reach out to Howard or Heather for more information. Howard and Heather, thank you so much for joining us today and for sharing your insights. And to everyone who joined us, thank you. We hope you enjoyed this lively and timely topic. The winner of today's snack basket is Brendan Driscoll of Driscoll Electric. Brendan, congratulations. Someone from our team will be reaching out shortly for shipping information. Next week, we'll be looking at healthcare. We'll be joined by Kate Beardsley and Sarah Hughes from our healthcare practice to take a look at how providers can adjust to a post-COVID world, both strategically and financially. As always, I would like to thank everyone for joining us today. Hope you have a great rest of your week and look forward to seeing you on future sessions.